Hello, everybody. Welcome to week 49 of 2025. This is the Build Weekly Roundup, and as always, you have myself, Cameron Otsuka, and Matt Dines here to talk through kind of our top three topics of the week. Kicking us off in topics, we're going to talk about the RAM squeeze. I'll get into more detail on exactly what this means, but then Matt will then expand upon kind of the broader picture of what we're seeing going on in several different sectors across the economy. In topic two, we'll touch on Italy's what's going on with Italy's gold. I think there's a lot of headlines that I saw over the past couple of days that interested me, caused me to do a bit of a deep dive into how gold is stored, who has ownership over it. But I definitely think Matt has some really good insights there as well. And then we'll round out today with U.S. jobs. I think the image speaks a little bit to where that's headed, but I'll also let Matt touch on how that might apply to the broader economy as a whole. So let's just go ahead and jump right into it here. First off, RAM squeeze. Number one, out the gates, Micron announces exit from its crucial consumer business. For me, from coming from the tech side, this is really interesting for a couple of different reasons. Micron is the third largest RAM chip, memory chip provider. So you can actually buy chips from different named companies out there. If you go on Amazon right now, I'm sure you're going to find some different names than you're used to seeing. Uh, there's some fun ones like Team Group or something Yummy Boy or whatever. But all of
Yummy
those,
boy?
yeah, but all of those are just sourcing
Wouldn't trust
chips.
that RAM.
I mean, well, what they're actually doing though is they're sourcing the chip from these foundries, right? So you've got Samsung, number one, SK Hynix, number two, and number
Yeah.
three is Micron. So all they're really doing is saying, hey, send us the chips. We'll pay Micron, we'll pay Samsung, but then we'll create our own package. We'll put them together onto a board that we've designed. We'll decide whether or not it needs extra cooling, whatever it might be. So they can come up with things that are maybe more cost effective for people trying to buy a lower end RAM price stick, or there's higher end RAM that you can buy for maybe your gaming PC for people that want to have the fastest memory available, or in the specific case that we're going to talk about today, is for data centers where they generally need both fast timing as well as large amounts of RAM. So when you think about when you're building out a brand new data center, not only is it about GPUs, as has been the case for the last couple of months, it also applies to everything else that you need in the server, right? So specific to memory, you're seeing here Micron deciding the demand from the data center build out is so high that they just can't justify sending some of these chips over to the consumer side of the business, which frankly has lower margins usually as well as lower overall order sizes. So Micron, again, on the left hand side of this image here, putting out their press release. And then on the right hand side, this is the tweet from Crucial saying, thank you for 29 amazing years. I think if you're a consumer on the gaming side, this is probably a big blow to you. I would expect, if you're into anything, computers, tech, all of that, you're going to start to see prices rising, and they have been. Right here is the average price in dollars over the last 18 months for DDR5 6000. So doesn't really matter. Disregard those first two numbers, but 2 by 16 gigabytes. That's 32 gigabytes of RAM. That's about what you see in most desktop PCs today. Any brand new laptop, for example, probably has something similar to these chips inside of them, about the same size and timing. But you can just see here on this chart, I mean, it's been relatively flat up until the last couple of months, and you just see this uptrend. So I'm gonna throw it over to Matt here. Maybe can you help me understand how does this fit into the broader picture? Because from my perspective, it seems like it's just this data center piece that's affecting RAM, storage, etc. But it sounds like there might be something more going on across the globe.
All right, let's stay on this slide.
Yeah.
I'll get to the backdrop. What are you looking at here? But start with the underlying fundamentals. You've got the AI kind of ramp up, the capex, accounting for a significant share of U.S. domestic economic growth. So you think about, I'm gonna make a comparison into the 2000s in a few minutes from now. But what's happening is this is the growth engine of the U.S. economy. We're betting it all on red here. AI is what we're going to go with. We need that productivity, um, given the workforce demographics, just what the credit system needs. You need productivity improvements, over time, in order to expand credit into the economy. It's where this thing comes from. That is its lifeblood. So we've basically made the strategic decision. We're going all in on the AI trend. I've said this before. We're not going to know until 5 to 10 years into the future whether these investments pan out. Just something, you have to kind of like throw the darts in the dark, uh, take the trust fall backwards into the leap of faith, whatever analogy you want to make. But that's kind of how this always works in the course of human history with societies betting on new technologies. But this is an important one because it's ours. It's our generation's era that we're falling into. So what we're looking at here, set that backdrop. The U.S. economic growth engine, we bet the farm on AI. That's crystal clear at this point. We talked about that last week with the Genesis project, all of that. We're pot committed. So what you're seeing here on this chart of DDR5 memory, you notice it's relatively stable up until roughly mid-September. Then we start to go up. It starts to look like that banana peel. What that's showing you is the demand side, the consumption, sticks of memory in these data centers. They're bumping up against their supply constraint. This is what happens. The growth engine of the economy. This ties into the money, credit, and asset prices framework that we've talked about in prior episodes as well. While the economy is in a growth cycle, while growth is positive, once you get, late game into the stress into that kind of entire machinery, what you'll see is the build out or the demand for resources in the economy start to price up against the economy's supply capacity, right? You think about capacity, you've got Crucial, which is, a division of Micron. Those memory sticks are manufactured, some in Boise, Idaho, some of them are offshore in Taiwan or South Korea is where, tends to be predominant in the memory production. Um, and then you've got other sources of producers coming mainly from South Korea, SK Hynix and Samsung Electronics. But what this is showing is this demand, this AI data center build out, which you hear the blurbs in the headlines like, oh, this, how many football fields long is this facility that Meta's building? How big is this one? Like, they're huge. It's massive capex. And what this chart is showing you, it's just one of many data points that's showing you that this entire growth complex, the demand side and the build out is bumping right up against the supply constraints that the actual economy is able to deliver, right? That's where you're starting to see already, like when price starts to run up on a key input to making that, think about this as a pipeline, a manufacturing pipeline where you start with the inputs, you got raw data, you got a data center, you got server racks, a couple of employees maybe, um, cooling, but then you also got the RAM, right? The output is AI models, right? Just get better models, expand the frontier. What you're seeing happen here as that price goes up is literally that bid up in resources to the extreme. Eventually, what happens here is you tend to get a buckling, right? The resources will get priced up until the last marginal buyer wins the auction. Same thing as like the Dutch auction framework, if you're familiar with this. This is a typical eBay auction, right? You have a timeline. Now, in this case, you don't know when the auction ends, right? The end date is whenever the last marginal buyer gets priced out. It's like bidding for horses or whatnot and raising your paddle, right? Everybody is, raising their paddle, marking up price, marking up price, marking up price, marking up price. And then you get what's called the winner's curse, right? The guy who pays the most is the last one standing. He wins the chips. But at that point, all the resources price out, and you get a kind of a reset as the profitability constraint. Can you make that output? In this case, the AI frontier model with your given set of inputs at the prices that the supply side of the economy can deliver. Once that washes out and we see like, profits dry up or cash flows dry up or capital available for investment into this space dries up, that's when you see this thing peter out. So what we're seeing right now, this is just my color. This crucial decision, and that's the U.S. domestic producer in this kind of global memory industry, right? We talked about the South Korean producers being the predominant market share, but what Crucial is representing is the U.S. Flagship memory producer based out of Boise, Idaho, pulling back, and they're saying we are not going to supply the consumer market. We are going to focus on the highest marginal buyer, highest price marginal buying consumer, which is the commercial data center build out, right? So that's kind of your suppliers, triage, if you will, to continue providing resources into this very hungry demand build out. So what you're doing is you're giving up one customer base to focus on another. And what this essentially does, it doesn't say like the musical chairs, the game is over, music stopped, etc. It's really an extension move. You're saying, home gamer, business laptop, what have you. We're going to underserve that market, which means, this highlights what Cameron talked about earlier. You go to Amazon, who are the chip manufacturers now that you're going to see if you're that gamer, looking for a memory stick? It's going to probably be an off-brand. Most likely it's going to be coming from mainland China. It's not going to be SK Hynix, Samsung, or Crucial anymore, or Micron. You're going to have to go to another supplier. And in this case, it means China, most likely. But what this really does, and it extends this growth phase slightly. It's hard to know what inning you're in until you get there. Sixth, seventh, et cetera, for this wave. But what it does represent, in my mind, along with all of those other headlines you've been seeing, including this showing up at the national federal policy level with that Genesis announcement last week. It's basically an extension from the production side of this industry to continue this build out as long as possible. Now, I'm going to make another analogy here, something similar. Think about resources in the economy, the inputs that are key to economic growth under a model. Prior to, let's say, 2010, pre-GFC, globally, that core input in the 20th century, maybe early 21st century, was oil, right? We were on an oil economy. To get more growth output, you needed to get barrels of oil into your economy and consumed, making whatever, gas in the cars, diesel for building, real estate, buildings, etc. Anything. You put a barrel of oil into anything, you can make so many different finished goods out of it. But the analogy I want to make here, in the 2000s growth engine, what we were running up to was the constraint, right? We were running out, this is pre-shale, so we didn't know we didn't really have the technology fully deployed yet to flip the US from a net oil consumer to a net producer as we are today. But what we saw between basically 2002, 2003, up until the GFC, summer of 2008, or right with the collapse of Lehman, what we were doing was basically what I talked about with, the prices of memory starting to hockey stick, the key input to economic growth. You saw the barrel of oil get priced up to, I think it reached well over $100 for the first time. I priced it here in terms of number of hours worked, in terms of the average hourly earnings of non-supervisory employees. So just how many hours did your average American have to work to be able to afford that barrel of oil? And that just spread into the input cost to fund their entire life, right? Get in their house, their car, all of the, intermediate goods or consumption goods that are in their house, everything, plastics, et cetera. And so what you saw is that price go up from 2 hours for a barrel of oil worked and the, early to mid 2000s, let's say post-dot-com bubble, it squeezes up to 8 hours of work, which for most people is a full workday for one barrel of oil. That's what I'm talking about, this resource pricing. Everybody will bid after it, they'll bid up the resources, so long as the marginal buyer sees positive value or positive profits based on those input costs. But once the price starts to get too high, it's kind of like Wile E. Coyote running over the cliff. He doesn't look back and realize, hey, I'm not on solid ground. In the cartoon, gravity doesn't take over until he realizes there's no other bid below him, right? And then it's a quick drop. That's, in my opinion, if you're looking at an analogy to the 2000s, like what happened with oil, that's kind of the same process of what resources would be showing with this AI development trend, which is it is the driver of economic growth, and it has been in the entirety of the post-COVID geopolitical world. So that's what we're watching. But crucial, that announcement after 29 years, they're retiring the consumer brand. This is why they're going to focus on that customer segment that they view as more critical. It also brings into question the decoupling narrative or theme you're talking about between U.S. and China. I'm sorry, but the U.S. office worker, the video gamers, et cetera, will not be happy if we do not allow imports from the Chinese memory industry at this point. So it's a continuation on multiple of the big themes that Cameron and I have been talking about and raising awareness on over the course of the year.
Absolutely. And so from there, I think, the to me when I see prices like this, going back to the memory piece, when I see that spike, it just tells me that I know that there's going to either have to be, some type of a shift in how we're supplying these chips, right? We're going to have to create more capex to bring that either onshore to some of our partners, or we're going to have to, change demand,
It's
which I don't think that's going to be a thing that people are going to be willing
yeah,
to do.
demand's not done. Like
Right.
like this squeeze you saw in the prior chart from $100 a stick roughly to 400. That's first wave of a breakage. Like exponential charts can get far higher than this. So this may be a development that's just getting started, and to resolve it, to build out more supply, building a chip fab or a memory fab facility, they're also capex intensive. So and they take time. So it's going to be really hard to keep supply and demand in balance in this 2020s growth wave we're in.
Absolutely. So I apologize if there's any background noise right now. My neighbor just decided to start leaf blowing, but let's move ahead to what's going on in Italy. So, I'm gonna flip us over to the next slide here. I saw this a couple days ago. Matt definitely called it out as a topic that we need to talk about on this week's podcast. But uh, Giorgia Meloni's party pushing to declare Italy's gold property of the people. Right. So that's December 1st. I saw this headline and I thought to myself, is Italy's gold not the property of its people? And I had a lot of questions on why is it such a big deal? Why is it making headlines? And what is actually going on under the surface here? So I started to dig into it a bit. But Matt, I'm gonna just throw it to you. Explain to me why is it such a big deal that Giorgia Meloni's party is saying it's now the property of the people? Why is that not already the case? I guess is my first
Yeah,
question. And then secondarily, the second headline, why is the ECB so seemingly upset that they're trying to make this push?
yeah. Um, so I'll once again make another comparison. When George Maloney says the gold is the property of the people, right? I'm not 100% certain that it follows the same kind of framework that we're used to in the US for most of our audience. Who owns the gold, right? The gold in Fort Knox and West Point, and to a very small degree in a vault in Colorado, owned by the US Treasury, like that is the property of the people. By definition, like, yeah, it is the US Treasury's gold. It's in US Treasury vaults. It's not in a bank vault, right? The way the US gold situation kind of resolves itself, I'll do a compare and contrast here because it highlights the differences um, and the added level of uncertainty facing Europe and its credit money, banking situation, sovereign issues, all of the above. In the US, most of us are familiar with Executive Order 6102. Basically, what that amounts to is the United States public sector, the US Treasury, bailed out the banking system after, there was just mass defaults, insolvency, et cetera, in the US banking system, as a result and following the 1929 crash. What FDR and his Treasury Secretary did when they came in, and this is where you see like the nationalization or the confiscation, some people would say, of gold. What they actually did is they reliquefied the banking system with a dollar bailout, if they will. They injected dollar liquidity to get the credit system out of its insolvency state, and they acquired all of the gold reserves on behalf of that. So it was literally a dollars for hard gold swap, if you will. And then they also went, a step beyond and made it illegal for private citizens or the private sector to own gold itself inside the U.S.
Right.
So in that case, you would make the claim or make the statement, and this would probably hold true in the United States. The gold is the property of the people. It's a U.S. Treasury asset. U.S. Treasury custodies it in the military facilities, right? It's held with the military. It's in Fort Knox and it's in West Point. What the banking system has is your paper claims on those gold. They're gold certificates, if you will, and those are they sit there, at the Fed's, basically holdings accounts, if you will, for the U.S. Treasury. I don't think they're included as part of the TGA. It's like a sub account, these gold claims. And they're not marked up. They're not marked to market. They're just sitting there to reflect that, hey, the Treasury owns this gold. Here's the price it's marked at. It's somewhere, mid 30s. It's like $35, $37 an ounce. Nowhere
I
close
was
to
gonna say, I remember you
the
saying it's
4,000 to
extremely.
4,500.
Yeah.
Yeah. Yep. So in the US case, the people own the gold, and that's a result of what happened in the 1930s, right? What you're looking at in the Italian scenario and the entire situation of basically the monetary union is a complete mess, right? And that's my term, not a technical term. Um, but what you're looking at, so the Italian banks had their own gold reserves, and Italy's actually reportedly, just based on the numbers that are printed, this may not line up with actual reality of how much actual precious metal is in each country's or each central bank's vaults. Um, but Italy is reportedly the number three highest on the league tables of gold holdings for sovereign entities. How was that gold acquired? Well, it's the reserves of their banking system over time, right? And this is from the legacy gold standard model. The banks built up and domestic economies built up gold reserves through their surplus, right? That's really where the U.S. kind of, if it does reportedly own the gold it holds, we it's well known that the U.S. has been um, a deficit trade balance country for 50, 60, 70 years, basically the entire post World War II era. Same thing with its fiscal accounts, right? The public debt. So you got the dual deficit situation. There's no real way to build up gold reserves when you're running twin deficits or a current account deficit.
Yeah.
What you would build up your gold reserves from is in your banking system if you're building up a surplus and acquiring gold in vault, which are then kind of fractionally reserved up for the credit claims or as credit issuance, as monetary creation on top of the gold sitting in your vaults, right? So that's how banking worked, on a pegged exchange rate standard. We've gotten rid of that where we have, post 1971, we have free floating fiat currency or sovereign currency units in terms of their market pricing against gold. But in the case of the ECB, which is really like a 1990s development, you had a new startup where you try to begin this monetary union. And basically, what the ECB, the way it worked is you would have each one of these European nation states give up their existing sovereign currency. So the Italian lira, the German mark, the French franc, what have you, every country. They basically post an ante, if you will, like a contribution to the European Central Bank. There's a fixed exchange rate then between the old currency that would be retired, so in this case the Italian lira, and when they make that switch to get your euros, right, which are reserve denominated at the ultimate buyer of last resort or lender of last resort at the ECB. To get into that club, you had to post your ante, and the way it was structured, 15% of that had to be in gold. So we'll go through the gold reserves charts. ECB has about 500 tons of gold reserves, and that's in comparison to Italy's, which if we go to the next chart, this would be 8. Cameron, the top 17 gold holders. You've still got Italy holding about 2,500 tons of gold reserves, right? You can compare it to Germany as well as number 2 on the list, France number 4. So the actual national central banks, the banks hold their gold in reserves. It's not the situation in the U.S., is my understanding, where it's actually the public sector treasuries who acquired those reserves. It's the banking system itself, right? So to make that claim, these are the assets of the people. You've also got not a clean mapping. It's not one-to-one. You have a sovereign banking system, the Italian central bank, the Bank of Italy, right? Which is your central bank, your lender of last resorts for the Italian banks. But it's not a clean one-to-one mapping where your public sector owns the gold, which would be in our case the U.S. Treasury, or I think it's the Italian Ministry of Finance. It's like the MEF, I think is the acronym. But it's their equivalent of the public treasury. It's actually the public-private layer, the banking system itself, that owns the gold and that hold the claims on those reserves. And in the case of the Fed, right, you would kind of consider it a public entity, right? Especially after the 1935 FOMC actions, where FDR in the U.S. put in this Washington, D.C. branch, which now operates out of the Eccles building. You have the Fed Board of Governors. Washington, D.C. gets to choose 7 out of 12 of the annual voting members who decide monetary policy. So it's a quasi-public institution at this point. That's how the U.S. structure works. Italy, it may be the case. I'm not fully aware of the history and the law. I think each one of these countries requires its own deep dive case study because they're not all the same thing. It's not all apples to apples. Everything's created equal. But in this case, my understanding, it is not the Ministry of Finance's technical gold claims, which Maloney is saying these are the assets of the people. What I would view this as, Georgia Maloney represents what I would call not quite the full-on populist extreme wing that the kind of European technocrats are really trying to push back against. Like you see this trend, AfD in German elections. It's very clear that the European Commission, the ECB, and then the the domestic policy factions like the Social Democrats in Germany, they do not want to see the nationalist wings just win seats in elections or win any popular control. Giorgia Meloni in Italy is kind of the furthest that an individual country or nation state within this European Commission framework has gotten in terms of leaning towards the more nationalist governing faction taking control since the European Union really got underway in the 80s, 90s, and has developed into what it is today. So what I view this fight over, if you just dive in between the weeds, what it actually is representing is a challenge over who has operational authority of these gold reserves. In the European structure, you've got all of these national central banks. So you've got the Bundesbank, France has its central bank, Bank of Italy, et cetera. And each one of those are participating members. And then they kind of roll up or report to the ECB. That's how they posted their reserves. Remember, I talked about 15% of gold goes into that ante to get in that game to be able to tap the European Union's architecture as trying to create this consolidated currency, the euro, to deprecate all of these other nation state specific currencies. But the way the policy is structured, you get into like articles 30, 31 of their treaties. What's at stake here and what's actually being argued over is technically the operational authority over these gold reserves. And what does that actually mean? It structurally means the way that these treaties or agreements were written when Italy enters into the ECB, and this would apply to all the other nation states that have participated in the euro as well. What they actually give up is the operational authority over their gold reserves. So what does this mean? It's questions over basically monetary policy implementation as it relates to gold. So sales, say you wanted to sell some gold to, raise equity capital inside your banking system, what have you. Leasing, so lending your gold or use of that gold to other central banks or possibly outside of the euro, possibly inside of the European Monetary Union. Gold needs to make its way to London at this time, as kind of everybody is aware of. We won't touch that subject right now. Derivatives activity and reserve conversion operations. Under the existing framework, those activities are basically subordinated to the conditional approval set at the Euro system level. What do we mean by Euro system? It's Brussels, Frankfurt, where the technocrats live, which tend to reside in Northern Europe. So that's really what Meloni is arguing over here. It's not, retaking custody of gold. Cameron, do I have control here? Go to slide 6, where the gold actually sits. There's no gold being reclaimed, or that's not actually the issue here. Is Giorgia Meloni saying, "Hey, European Union, you have our gold. We want to take possession back." That's not the situation. So if a lot of the audience might be familiar with the 1971 Nixon defaulting on the gold convertibility window of the Bretton Woods system, right? Where France or Charles de Gaulle could ask for physical delivery of its gold, post dollars, get gold back. That's when Nixon said, "Nope, this is over." That's not the case here. The golden vault for Italy's reserves actually sits. It's basically call it 50-50. Half of it is in the Bank of Italy's vault in Rome, so they already have physical custody of their gold reserves. Like they have the metal within Italy's sovereign borders. The other roughly half, if you will, is at the Federal Reserve Bank of New York, and this is for this. You put your gold in New York for interacting with the dollar system, right? Settling trade there. So that's why it's 50-50. have some parked domestically to, basically have your domestic banking systems reserves pointing to. And then you have your other reserves in New York. That's for settling international trade. And then you've got tiny slivers at the Bank of England in London, and then the Swiss National Bank in Bern. This is the reported breakouts. Now, these may not be exact. This might not be actually be where the gold is. But for the most part, I would find it credible. It's roughly a 50-50 split. The gold's already, possession's 9/10 of the law, right? As everybody kind of knows the saying. It's already in Rome. It's already in New York. Notice that's not in Brussels. That's not in Frankfurt. So there's no gold that they're calling and saying, "Hey, give us our gold. We're taking physical delivery." This is purely it's an operational authority challenge to the broader kind of technocratic project that is putting together this European Union. And why would this be the case now? Well, if you go back to the charts, you see like which countries hold the gold: Germany, Italy, France. Those are your three largest economies in the EU. ECB, collectively, if you add up those three reserves that each one of their central or each of the national central banks holds, it doesn't even hold a candle, right? ECB's gold reserves are tiny in comparison. So then if you look at the marking to market, right, with gold prices rallying in 2024, 2025, basically what this is saying, in my opinion, so you're looking at a banking system, right? The more gold reserves it has, the higher quality its IOUs would be perceived, or more credible those IOUs, or the credit stack, basically that's levered on top of it, that is fractional reserve banking. What you're actually seeing now with the gold rally is basically a shift in perception. The power is tilting away from that centralized authority, the technocratic project in the EU, and more towards those own sovereign nation states. And this plays into the broader theme. You're seeing this in Germany as well. You've got a big pension bill coming up for election, or up for vote tomorrow. That's highly controversial. We're talking about a split, or the Merz governing faction losing its control. What this is basically playing out is basically tilting the balance of power in on the European peninsula, effectively, I think, away from the big group building project that is the EU, that's been underway for 40, 50 years in the making, and back towards the sovereign nation states that are largely driven by national identity and ethnicity. So this is a continue to watch. This isn't something that's going to resolve itself in a couple of weeks or headlines. I think this is part of a big picture story, but it is a key development with Georgia Maloney in terms of a signpost on this trend that can run for potentially the decade ahead, or possibly beyond. So yeah, this is a big development this week.
Yeah, thanks for contextualizing that for me because I'm sure, like many in our audience, I saw that headline and I thought, okay, it seems important, but don't quite fully understand how this fits into the broader picture. So that's super helpful. And I also think, there's a lot of research we could probably do. Obviously, like you called out with Germany, but looking down this list here, you've got France, you've got Switzerland, you've got India, Japan, right? I mean, a lot of names that pop out here of top gold holders. Seems like there's shifts in maybe how they're interacting with the rest of the world related to that. So definitely something to
Yep,
keep an
it's
eye
a
on.
tug of war. The rope in this case, to make a crude analogy, the rope is the national central bank, and in my kind of framework or understanding of the context, on one side of the rope you've got um, the nation state itself, Italy, and that's Maloney saying like, "Hey, this is the people's," and on the other side of the rope you've got the consolidation technocrats, the European Union. Project builders, if you will, and that's the tug of war going on. I won't do that hand motion again because it wasn't flattering. I can see the video of myself, but that's what's going on here. It's a tug of war.
Got it. All right. Well,
We'll see.
let's.
We'll see how this plays out. But the gold marking to market, the golden rule, not the one you'll find in the New Testament, but the one you'll hear the banker or the merchant say, "He who has the gold makes the rules." I would default to that here in an era where market price is clearly showing you again that the gold is important. It's going to play an important role in banking and which systems are credible and solvent. So I would lean towards that golden rule. If you had to pick a winner here, it's he who has the gold makes the rules. So I'd bet on the nation states. Italy is clearly at the front line. Let's continue to watch how things develop in Germany and France, but there's big issues there going on. We've talked about the French one, just the cyclical rotations of prime ministers, these legacy wings. The Macron government is basically just hanging on, trying to figure this out, how to keep kicking the can. And you've got the kind of the nation state populist wing with Marine Le Pen and her party, which is they're basically just trying to change the rules as they go to keep the national populist movements from gaining power, which will just completely just halt all progress on this unification project. Same things are starting to take place in Germany. You've got an economy that's really just limping along. The German economy is really struggling. It's really weakly coming out of its recession in 2022, 2023. And then you've got the same issues as France with the pension funding. And you've got a natural kind of intergenerational divide developing between the young workers and then the old pensioners. Something's got to give, but like I said, we'll watch this closely. But this was a key development this week with kind of Maloney and Italy being on the cutting edge of this process that's taking shape.
Absolutely. All right, well, let's turn domestically here. So, the third topic of the week, US jobs. I'm going to flip us to the slide here. Matt, I saw kind of the negative net change here, but maybe can you provide some context first off, and secondarily, how does this kind of impact what you see moving forward from both the Trump admin, but also kind of the economy broadly?
Yep. So if you go back, you watch like the monetary policy, the FOMC press conferences, and you pay attention to what language or what inputs or which of the key objectives, the mandates of, say, the Federal Reserve with monetary policy, um, are the most in focus right now. What's the more operationally binding constraint there between those two mandates, full employment or stable prices, right? It's become very clear in 2025 that risk has become full employment. A lot of this is coming from White House policy. You've got a changing of the guard, new sheriff in town, um, an objectively different policy path than what we were operating under in the Biden administration from 2020 to 2024 on immigration, budget, tariffs, et cetera. Right. So if you look at this chart, and this is the ADP employment survey, using this one because for during the government shutdown, we didn't get the numbers for the government or the federal government's the BLS, the non-farm payrolls report. So this is all we have. We also know, the BLS's NFP numbers are really model based. They're guesstimates. In my opinion, credibility is highly dependent on what the Treasury needs to do, the bond market to do. As the deficit situation, the debt situation has gotten into backed into a corner, and we need to carefully manage. Interest expense as its share of tax receipts and the federal budget. So I think there naturally is some politics that go into that process as well. I don't know if it's not 100% political in terms of those data series. They're, it's very clear in the historical data. They're going to be deeply revised years after the fact. So there is some incentive there to have the numbers show what the supplier or the producer of those metrics wants or needs them to show. I think is not that controversial of a statement. But anyway, ADP numbers, they're private based on the modeling of one of the largest kind of payroll software operators, automatic data processing in the U.S. economy. So they're based on real data, not just back end estimates, birth death estimates of small businesses, just based on guesswork, stuff like that. But what you see since especially Liberation Day, you see I don't have the laser pointer on. But basically, just go back to March 2025, where ADP report looked somewhat strong in terms of 100 to 150,000 jobs created. Basically, since Liberation Day, and the Trump administration has gotten its policy set started to be enforced, both on tariffs and immigration. The job creation numbers have started to look soft, right? And so what you're seeing with the November number that just came in yesterday was actually contraction across both the goods producing side of the economy, shedding 19,000 jobs, and then services shedding 12,000 jobs, for total private sector contraction of 32,000 jobs lost. So in this new era with the White House, I'll go through the labor force growth and what the trends look like in a second. But steady state of job growth when immigration policies has essentially scaled back to basically zero. You saw this with the Trump announcement, I think, over Thanksgiving, right? Like governing by tweet, if you will. Just another one of those blasts. I think he said immigration is suspended from third world countries, right?
Yeah.
If I'm remembering that correctly. So basically, now we're looking at zero immigration on net, most likely, which kind of finds its way into stagnant population growth or very slow workforce growth. Um, so that's what you're seeing on the job front. And if you look at just monetary policy, interest rates, et cetera, this becomes your thing to watch. So this, if you notice, like once we get into September, the cuts started again. We got a cut in September, cut in October. Odds on we're going to get another cut in December. But if you look at the numbers, it's basically as soon as we saw that August softness in the jobs numbers, that's where Fed policy, shifted towards, hey, we're going to get back to resume cutting again, and it's really tying back to this slowdown in job growth in the U.S. economy, right? Um, Everything kind of plays into this picture. The AI growth engine running up against the economy's available supply of resources, all of that. But it just basically shows where we're at in the cycle. And right now, that cycle looks like short-term rates want to come in, and we'll see what that means for longer-term inflation expectations, further out on the yield curve. My baseline assumption would be to watch for, further steepening on the yield curve. I don't have the 210 chart on here, the 2-year to 10-year yield curve spread, but basically that's measuring the slope of the yield curve. Remember, 2-3 years ago, everybody on Twitter or X, topic of the day or on everybody's mind was the massive inversion on the yield curve. What that was doing was contracting money supply. We are back to a positively sloped yield curve. We're waiting, after the next few cuts, you should start seeing a fully normalized or positively sloped yield curve throughout. But in this kind of intermediate time between Liberation Day and basically, the time of this recording, that positive slope has stalled out, and we're just waiting for further cuts to re-engage that steepening in the yield curve. When that happens, credit creation takes place. That should shift, or right, is the hope, if it's effective, should shift the economy back into or financial, or sorry, it should shift the financial system back into balance sheet expansion and credit creation, which should hopefully tilt the real economy back into job creation, spending, consumption, et cetera. So that's what we're looking for on the backdrop. And this is the final thing. We'll close with this. If you're looking at the ADP private non-farm payroll survey, I think it's very clear now you're looking at a workforce that's an American workforce that's changed significantly in the post-COVID environment. If you look from 2010 to 2019, this is non-seasonally adjusted numbers. So you see the natural cycles of um, hiring layoffs after the Q4 holiday season. That's why we bottom out in Q1. Exactly. And then you ramp up, escalate into, Q3, the hiring gets done. Everybody ramps up for that last section of the season where Q4 tends to be your best quarter of the year for most businesses, especially the cyclicals. Um, but in the post GFC up until COVID environment, we were looking at basically a workforce growth rate of 2% annually. It's tied to jobs, job creation, and population growth. What you're looking at, post COVID, once you get out of the divot and you let all the stimulus policy work its way through, both monetary policy and fiscal, what we're looking at since 2022 is a growth in the workforce of basically 1.2%. So it's shrunk by, something like 40% in terms of the growth rate of the U.S. economy. That is significant. We're going to continue to deal with that for the next decade ahead. That's another one of these core trends we talk about. But at this point, those, cyclical job losses, recession, et cetera, that's the thing, in my mind, that Fed monetary policy and the Treasury itself are front and center, focused on in terms of their objective. So that's why you'll get rate cuts into a backdrop that isn't showing, short-term price rises or cyclical inflation, but over the post 2020 backdrop, and this is what it looks like, in my opinion, what we saw in 2022 with this price hikes. And I think you're continuing to see it in the prices of metals, right? You see the metals as your first level input in commodities, not just precious metals with gold, which is more of a currency, but industrial metals, silver, copper, et cetera. Those are starting to ramp up. Those inflationary pressures are definitely there. You're going to continue to see a debasement or loss of purchasing power in your credit unit's ability to, maintain their ability to buy goods and services that you've been used to. But this goes back to what we talked about with the Italy gold situation. The better reserve currencies, the ones that are hard backed in this case, are the ones that are going to or expected to perform better or stronger in this new backdrop we're in the post-COVID world. So continue to watch that. November's jobs print, 32,000 loss. It's kind of like you automatically expect the job cuts to start to come in after we're done with that holiday kind of Christmas season rush. They're already going to come in January. But in this case, the worry is, hey, they've already started even a little bit earlier, which is kind of signaling, oh, things might be a little softer than even we thought. Let's cut. So that's kind of the balancing dynamic you're looking at here from the domestic or U.S. perspective.
Lots of big news this week, I feel like. So, I think this is a good spot to leave it. But thank you again, Matt. I think, again, that gold section, if you kind of watch through that with us, highly recommend going back, listen to Matt again, because for me specifically, that was a lot of value for me, Matt. So thank you again.
Cool. It's a complex situation. We're just going to have to wait and see how that one plays out. But my default would be, where is the gold stored? It's in Rome. It's in New York. Uh, that's who if you're having to bet on coming out ahead, probably start with where's the vault, where's the gold located, and that's the horse to bet on in the race, in my opinion.
Well, with that, that's this week's show. Thank you again for everybody for watching Build Weekly Roundup. You can find myself and Matt on Twitter. Matt's handle is LeveredUSDs. Mine is Cameron Otsuka. As always, please like, subscribe, comment, whatever else you'd like, share. We're on YouTube, X, LinkedIn as well. See you all next week.